Good morning, everyone, and welcome to Argo's Investor Day. We're going around the country. We came out of COVID, I guess, and tried this last year where we combined the meetings of Argo Investments and Argo Infrastructure. A little bit more informal, a little bit more time for Q&A, which I think was relatively well received. So look, thanks for your support. Thanks for coming. My name's Jason Beddow. I'm the Managing Director of Argo Investments and Argo Infrastructure. On stage, I've got Paul Frost, one of the investment analysts at Argo, and a special guest, we've got Tyler Rosenlicht from Cohen & Steers. So it's Tyler's first trip to Adelaide. He went out for a run in the dark this morning because he's waking up at 3 a.m. He found the river and he thought it was a pretty nice place. So there you go. Tyler's one of the portfolio managers at Cohen & Steers on the infrastructure strategy, and he's been with Cohen & Steers for well before ALI came, and so we appreciate him coming out and talking about the listed infrastructure space. Format of the day, we have a brief disclaimer. This is just information, not advice. We've got, I guess, a bit of an update on, where we think the market is. Some of the stocks we've been, transacting in, a couple of sectors, and then into Argo Infrastructure, and we'll have plenty of time for question and answers. We're happy to try and answer any of your questions on anything, really. So thank you. Also, just like to acknowledge the traditional owners of the land on which we meet today. So this is, a chart we've sort of used for a number of years, but it does give, a nice overview of the world pre-COVID, but really what's happened post-COVID. And the world and markets really have continued to recover and move on from the COVID pandemic. Last year, central banks globally increased interest rates to combat the highest levels of inflation we'd seen for 40 years. And last year, for most of the year, the consensus view from economists around the world was that this rapid increase in interest rates would lead to a recession, probably led by the US, but then would spread potentially around the world. And this is reflected in the rather flat period of markets for nearly 2 years. So the green line, 2002 through to sort of October 2023, a bit of volatility, but relatively flat. However, this wasn't the case, and this really turned on its head towards the end of last year. There was a huge rally in global stock markets, including Australia. Australian market was up about 12.5% in November and December alone. Markets like the Nasdaq, I think, were up 25%. And this rally's continued. The ASX reached a record high on April 2nd. If the market's up today, it'll be another record high today. And this is the same with stock markets all around the Western world. So US, Japan, UK. And this was all aided really by the prospect of lower interest rates over the coming year, particularly in the US, but also Australia. The thing that's a bit of a quandary, though, is this hasn't happened. We've escaped a recession, but inflation remains sticky. And recent speculation in some quarters that the RBA's next move might actually be up, that they actually have to hike interest rates again. Now, we don't believe that's the case just yet, but we do think rates likely stay on hold at least into 2025 in Australia. So it remains one of the biggest, issues for investors here and globally. A higher for longer cash rate, in theory, should be a moderate headwind to markets. So, it's challenging, thinking about the markets at all-time highs and just what's going on in the world. I might just remind everyone, if you could just to turn your mobile phones to silent. Thank you. We've also got significant spending in Australia from both federal and state governments, and we've got sticky services inflation. So it makes the pathway for the RBA to get back to these inflation targets, quite challenging. One thing we also like about this chart is the orange line, and it sort of reminds us, but should investors, the accumulation index. This captures the dividends paid by companies in the index, and it continues to significantly contribute to the returns Australian investors get. So Australia is one of the highest yielding markets in the world, and that's, before we add back franking credits on top of this. And it does provide meaningful income and also inflation protected income, because if there's inflation, generally company profits are going up and their dividends should go up. So, they're also reaching all-time highs. Excuse me, I'll just have a sip of water. So this is just some numbers from our half-year result, which we reported in February. But we think we've navigated, I guess, what are relatively turbulent times in markets for shareholders relatively well. We returned to dividend growth post-COVID. We reported a record annual fully franked dividend at our last full year result, which is 34.5 cents per share. And when you translate that, that's about $264 million of fully franked dividends we're paying out annually to shareholders. The asset value has grown and the MER remains a very competitive 0.15%. The performance of the portfolio has been largely in line, I guess, with the market through this time. And probably one of the biggest criticisms of ourselves is we've probably been too conservative. Considering markets are at record highs, we've probably not adjusted our valuations to some of the market valuations, and we've been a little conservative, which at this point in time, has probably cost us a little performance, with markets at all-time highs. Another thing that I guess has changed in the short term, and it's a characteristic of listed investment companies, is the movement in the share price. And the share price can move differently to the net tangible assets, or NTA of the company. Argo is very fortunate that over a rolling 10-year period, the share price averages about 1% to 2% premium. But as you can see on this chart, the short-term periods, the discount premiums can fluctuate much more than that. So the Argo share price is currently trading, I think, about an 8% discount, which is larger than we've seen for some time. And look, we think there's a number of reasons for that. Some, I guess we can look at the data and we have a pretty good understanding. Some are a little more anecdotal, but it's impacting the whole LIC universe. So all of the LICs listed on the ASX, not just Argo. And 8% is actually one of the smaller discounts presently. We think one of the biggest impacts was during the COVID period when interest rates were zero. Argo added about 15,000 shareholders in that time. So that's arguably probably 13,000 more than we would normally get in the normal course. Argo does get new shareholders, maybe 1,000 a year or 1,000 every couple of years. We had 15,000. I guess these investors probably use term deposits or other cash alternatives, and we're getting zero. So they were forced to look elsewhere for some relatively safe income, and they bought into conservative LICs like Argo. Now, in this period, we traded it up to a 15% premium, and we also don't like trading, while it might look good as a share price, we also don't like trading at too big a premium because we know that over time, that is likely to mean revert, and there may be some disappointment. So we think some of the weakness in the share price has been with interest rates at 15 years highs, and you can quite easily get high fours, 5% risk-free on your money, that some of this money is returning to term deposits and other cash alternatives. So there has been some increased selling. The other thing that we can track through time is in rapidly increasing markets, the share price does not keep up to the NTA. So, we're, I think, 0.4% off an all-time high this morning as the ASX opens. And the market has been very, very strong. Typically through time when the share markets are very, very strong and go up quickly, the share price lags and really needs, the market to flatten out for a little while for the share price to catch up. A couple of other reasons are probably a little more anecdotal. We think some of the newer LICs, externally managed with high fees, have disappointed their shareholders, and this has perhaps negatively impacted the sentiment in the sector. And we do acknowledge the growth of the ETF sector. I mean, the ETFs we think are a very good vehicle for specialised sector access. If you're interested in biotech or healthcare in Europe, international, we think they're an excellent way for investors to gain exposure. However, if we think about a broader ASX alternative, we still think that the LIC company structure with our fully franked dividend, the retained earnings to protect future dividends, which is important, and comparable costs to an index ETF, which is a trust structure, which is quite different, they remain a superior investment vehicle over time. I mean, a general index ETF is index minus cost. It's not actually the index. And it's delivering an index level of dividend, which is reasonable, but during COVID, say was cut 50%. Argo as a company, we don't have to do that, and provides an index level of franking. So we still think it's a cyclical time for LICs. We think Argo, continues to offer an excellent long-term, low-cost investment product, and the current discount, I guess, if time is anything to go by, is an even more compelling prospect. The portfolio, look, at a sector level, and I guess in the larger holdings, doesn't materially change annually. Remains very well diversified across the industry groups. Most of our companies, I'd like to say, have strong balance sheets, reasonable long-term growth prospects despite the short-term economic uncertainties, and an attractive or growing yield. The biggest move over the last 12 months has probably been into banks and other financials, and it's largely because of share price increases. And I'll talk a little bit about the bank sector shortly, but they have had a stellar run. Again, back to that last 2 months of last year when the market was up, say, 12.5%. The banks are up 25, 30%, in the last sort of 7 or 8 months, which is a really large move for one of the biggest sectors in the market. Healthcare has been a really challenging sector. We've increased our weighting in healthcare, though this has been from purchases, with very little share price appreciation from most companies. And we're going to speak about, Paul will speak about the healthcare sector a little later. The only sector that's sort of shrunk materially is energy. And again, it's really been a result of weak share prices. So look, we try and diversify the portfolio. We are a low turnover product. We're trying to protect, I guess, the asset value, minimise the tax. So we want to try and maintain balanced performance over a longer period of time and deliver a relatively smooth dividend profile to shareholders through market cycles. It's an interesting time in the markets when we hit a record high. So this chart is showing the net equity issuance, so the increased equity available for investors, institutions, the industry super funds, us, yourself as individuals, to invest in. Financial crisis, a lot of capital raisings to sell balance sheets. Banks unquestionably strong, came out of the Royal Commission, they all needed to raise capital. And most years there's share purchase plans, DRPs and other raisings. So currently we've got markets at all-time high, and for the first time in history that we can get, the Aussie equity market is shrinking. Combination of, Argo itself has had 4 takeovers completed in the last, this financial year. We've got 2 further companies under takeover, Illumina and QIP, and there's several other potential takeovers in the market that we don't own. It's come at a time when there's very few IPOs of size, if any, that have come, and there's a record number of buybacks, including the banks, but many other companies. So the market's shrinking. And I guess, we're sort of thinking, what are the repercussions of this? Longer term, with more money looking to invest, we're sort of debating, what does this do to valuations? What do we have to do or think differently when we look at, how these companies are worth? I mean, it's likely to push valuations higher, and, we need to sort of consider that as we move forward. But it's an interesting time. Having said that, if the markets stay robust at all-time highs, we do think there's some pent-up demand of private equity players and others that will look to bring some new companies to the market. So the banks are a big part of the Australian market, about 25%, and 3 of the 4 big retail banks, have just reported their interim results, and Macquarie Group its full year result, and CBA puts out a quarterly update, so I guess you get an update from all of them. The bank results, the retail bank results, were sound. They were better than the market's expectations. And while the headline numbers were down and consistently down, the credit quality remains very good across the economy, despite cost of living pressures, interest rate pressures on household incomes. The bad debts that these banks are witnessing is almost non-existent. So the strong capital position of the big 4 banks was a highlight. From an operating perspective, it's the weaker net interest margins. So the margin the bank makes over the cost of their funding, whether it be deposits or wholesale funding, to their lending, that's been the biggest headwind. It's been very competitive. We've seen that in mortgages and other products over the last couple of years. We do think the NIM, while it remains under pressure, improving dynamics, less cashbacks. I think Westpac's going to stop the last cashback from the Big Four in June, if you're looking to flip your mortgage, or if any of your children or have mortgages. And so less discounting should help the NIM. One part of the economy that has actually been very strong is business banking. Business lending has been very strong and remains one of the strongest parts of the economy. We just recently caught up with the new CEO of NAB. Their internal economist was predicting business growth in the economy of 3% for the first half for NAB, and it was 9%. So I'm not sure where all the entrepreneurs are and what is being lent. We didn't sort of get down into that, but that part of the economy is very strong. Clearly, that's been identified by every other bank as a market they all want to go after. So we would expect some more competition in that space. Pleasingly, with the extra capital, all the banks increased their dividends. They're all now closer to the top of their payouts, and ANZ and Westpac announced additional buybacks. So CBA and NAB also have buybacks going. So there's about $8 billion of stock being bought back by the Big Four. This will help to, I guess, offset what still appears to be, relatively sluggish earnings. But the banks themselves have had a stellar bounce if we go back to sort of the dip in November. One of the best periods, which is, I guess we stand back and we think, the economy is clearly stronger than we thought it would be, or what the economists we were reading at least thought it would be. So they've had an outstanding run. I mean, we're not sure that they can do much better, I guess, in the short term. Now they've all gone ex-dividend. But we do believe the increased dividends, ongoing buyback support, probably supports the bank share prices around these levels, short of something untoward happening in the economy, which we haven't predicted. But it does, they do look very expensive. And I saw a table this morning. I think that 3 of the 4 are the 4 most expensive banks in the world. Not saying they're not good quality. And the other piece of news was the ACCC approved the merger of ANZ and Suncorp Bank. So ANZ will increase its size in mortgages. Macquarie's a bit different. I mean, Macquarie, while it does participate in the Australian banking industry, it's about 15% of their business. The headline result for Macquarie was significantly weaker. They had a record last year in their commodities business and their asset management business, and comparing PCP, they had a fairly weak result. Macquarie is Argo's largest position, and we still continue to believe it's very well positioned for what's happening around the world, in decarbonisation, commodities and infrastructure. And clearly we'll hear a lot more about infrastructure from Tyler. We've been relatively active, even though not in a particularly big way. Overall, I guess we've been adding to existing holdings and reducing the overall number of holdings in the portfolio, apart from a couple. We talked about ResMed at the AGM last year. We saw an opportunity in ResMed, and we've been adding to that. And we did add a small pure play copper producer, which is Metals Acquisition Corp, which listed on the ASX in February. And with record copper price last night, it's actually done relatively well, and we probably should have more of it. We've exited 4 takeover targets. We exited Liontown Resources at the Albemarle bid price of $3, even though that takeover actually subsequently fell over. Estia Health and Invacare, following the final dividend payments, which exhausted their franking credits. And we've sold out of Adbri, which was formerly known and probably well known in South Australia as Adelaide Brighton. There was no franking credits as part of that takeover. We've exited our holding in IAG, which was relatively small. And we've just trimmed a small portion in a number of holdings that we feel are getting very fully valued, even though we still think they're excellent quality companies. Wesfarmers, Reece, Helia, Fleet Partners. But I guess if we want to invest new capital, or where we think there's better ideas, we need to realise some. Proceeds from these sales have been redeployed into a number of stocks. Paul will talk a little bit about ResMed and CSL. We've been attracted, I guess, to the cash flows that, for our sins, and probably a very well-known company, Santos, from a share price perspective, has been pretty disappointing over the last couple of years, but we think it's coming to the end of its CapEx cycle as we get into 25. If it follows the playbook of the big offshore oil and gas companies, it should be generating a lot of cash, and we'll be forced to probably pay higher dividends and buy back stock. Similarly with another number of the names, Viva just consummated the OTR, again, another well-known business here. So they've bought On the Run, and they intend to roll that out through their whole chain of service stations. So similar with APA and Origin, these businesses, share price wise, haven't done a lot, but we think they're coming into a period where they're going to generate a lot of cash. Woolworths a little bit different. Woolworths is a good quality company. Clearly, it's under the spotlight. They've got a send inquiry into supermarkets and the pricing, and so Woolworths share price has come from $40 down to $30. Brad's leaving, long-time CEO, and so it's a little bit disruptive. So we think the market's probably oversold Woolworths on a long-term view. IDP we've continued to buy, and we called out this stock last year as a stock we thought was really interesting. And to be frank, it's been quite disappointing from a share price perspective. But we do think the company itself, the fundamentals are exactly the same, and in fact are probably better for a quality player. What's been the real challenge for IDP though is with housing shortages in a lot of the Western world and cost of living challenges, a number of the end markets for students has come under a lot of political pressure, largely Australia, the UK and Canada, which is the end markets. And so I guess if the number of students moving around the world is significantly lower, the potential market for IDP currently is less. And so that has short-term interrupted their business, but we do quite like it longer term. And look, happy to take any questions on anything. Also, I should probably have mentioned the slides we released to the ASX yesterday. They're also on our website. So if you want to flick back through them later on. Healthcare, I guess, has been one of the great long-term success stories in Australia. It's an extremely diverse sector if you think about the different companies, but we have, grown some truly world-class businesses, and CSL, Cochlear, ResMed, come to mind. COVID had a really big impact on healthcare, probably the biggest impact of any sector. And, since this is a 1 year, but you could go back 2 or 3 years. Since COVID, for various reasons, the healthcare sector has been quite disappointing. Some of it's earnings, some of it is consumer or patient behaviour, some of it's government funding. And so in a market that's at all-time highs, we think the underperformance of healthcare makes it really interesting to do some more work on for further selective investment. So I'm now going to turn to Paul, and he's going to run through the healthcare sector, I guess, as we and he sees it.
Well, thank you, Jason, and welcome to all shareholders who've attended today. My name's Paul Frost. Today, I'll provide an overview of our thoughts on the healthcare sector and touch on some of the investment opportunities in the space that we've recently taken advantage of. I'll focus on demographic trends and its implications for the sector of an ageing population. We'll also touch on healthcare expenditure globally and trends there. We'll look at how Argo profiles the ASX-listed healthcare sector, some industry dynamics, some key tailwinds, but also some headwinds in the sector at the moment. Industry winners and losers through the peak COVID period, but also coming out of the post-COVID environment. And then we'll look at some investment opportunities and some short-term challenges in the sector holdings that Argo has. So to understand the prevailing industry dynamics and medium-term outlook for the healthcare sector, we felt it's useful to profile demographic trends. And in this regard, there's clear evidence of an ageing population globally. If you look at the 2 top bars, they're just the profile of an ageing population over the next 30 years. This ageing demographic is consistent in many developed countries, including the US, Japan, Europe and Australia. And as people age, the increased incidence of chronic disease and comorbidities is expected to underpin sustained demand for healthcare services over the medium term. This demographic tailwind is also reflected in the quantum of healthcare expenditure globally. Again, this World Bank data highlights some strong historic growth in healthcare expenditure as a percentage of GDP. And this healthcare expenditure is only expected to increase with an ageing population seeking access to services. And at a country level, there are some quite significant variations in the level of healthcare expenditure on a per capita basis. The US is a clear outlier here, with per capita spend of around $12,500 per person, and that's about 50 to 100% higher than other nations, and that's expected to continue in the foreseeable future. And this regional dynamic should present meaningful growth opportunities for those healthcare companies in Argo's portfolio which have a strong international presence, and we'll touch on a couple of those later. This expenditure trend is really no different in Australia. The 2023 intergenerational report issued by Treasury forecast strong growth in healthcare spend in real dollars out to 2060. And much of that growth has been driven by ageing and population effects. So with that backdrop in mind, let's turn to how Argo profiles the ASX-listed healthcare sector. We break down the sector into two broad categories, core and niche. And some examples in the niche sector include companies like biotechs, early stage drug discovery through the phase 3 clinical trials, rare disease therapies like orphan drugs, which service very small markets, and radiopharmaceuticals, targeted diagnostics and therapeutics, particularly in the oncology space. Historically, companies in this niche sector, this niche category, have formed a very small part of Argo's portfolio. They're typically pre-revenue companies, they're capital hungry, and they involve long duration clinical phasing prior to product commercialisation. However, we keep a watchful eye on this space to monitor industry innovation, as well as understanding sort of potential opportunities and threats. Today, we'll focus largely on the core category, and this is where Argo has the bulk of its investments, healthcare investments. We break down this category into 4 subsegments. So from the top left, services, and this includes the likes of GPs, fertility services, pathology, radiology, allied health, and funerals. In the infrastructure space, capture the hospital operators and aged care, in devices and consumables for hearing loss and respiratory conditions like sleep apnea. And then the 4th quartile, product manufacture and distribution, which captures drugs, plasma, vaccines, and pharmacy. So in which quadrant do the core healthcare companies operate? Well, in the services space, we have companies like Sonic Healthcare, Helios, Monash IVF, and formerly Invacare, which, as Jason mentioned, subject to a takeover. In the infrastructure space, companies like Ramsay Healthcare, Regis, and formerly Estia Health, another aged care operator that was taken out. In the devices and consumables space, companies like Cochlear, ResMed, and Fisher & Paykel Healthcare. And in product manufacture and distribution, companies like CSL in the plasma space, Main Pharma, Sigma, and EBOS. Argo has strong investment holdings in several of these core healthcare companies. However, we continue to monitor many other companies in this category, preferring to wait for more attractive opportunities to invest our shareholders' capital. Valuation appeal is typically the major constraint holding us back from investing in certain companies. For example, Cochlear and Pro Medicus, which trade on extreme valuation premiums at the moment. A broad market dislocation or a share price derating, however, may provide the opportunity to revisit these companies, subject to there being no major structural changes to the growth outlook for those companies. So apart from a steady return to a more normal operating environment, whatever that looks like, following the COVID pandemic, the healthcare sector continues to experience several tailwinds as well as some headwinds and potential uncertainties. As I mentioned before, the sector will clearly benefit from tailwinds associated with an ageing population and increased incidence of chronic disease. Some other tailwinds include regulatory standards and reform, and this creates high barriers to entry for new players and in effect becomes a licence to operate in the space. Growing consumer awareness of preventative health is a major driver. Public sector wait lists as well, and government fiscal pressures are driving increased outsourcing of elective surgery wait lists. We'll see further advancements in medical science, which will be a tailwind. But lastly, technology and digitisation, which is delivering productivity gains and workflow benefits to operators. Equally, the sector faces some headwinds and challenges, some of which are short-term and others are more medium-term. These include things like government funding risk and question marks over future funding models and what they look like. Secondly, the lack of or inadequate Medicare or MBS indexation, and particularly in an environment that we're facing at the moment where we have high levels of inflation and those indexation outcomes have been very low. Nursing and GP shortages remain a global challenge. And consumer affordability and product access is a tailwind as well in terms of access to drugs and potential out-of-pocket costs. So over a long period of time, as Jace mentioned, the healthcare sector has generated and delivered consistent, steady returns to shareholders underpinned by long-term favourable industry dynamics. However, this trend was really flipped on its head following the outbreak of COVID. This healthcare crisis, proved to be highly disruptive for most, if not all, sector operators, as we all know. And for some, it continues to present challenges as the broader industry seeks to return to a more normal operating cadence. Significant pandemic-related challenges include supply chain disruptions, which limited access to essential equipment, components and supplies, the effective nationalisation of private hospital bed capacity, and that was only partly offset by profit-neutral funding arrangements with government. Labour shortages and attrition, particularly amongst nurses and doctors, and heightened stress across the healthcare workforce. And visitation disruption as well. Safety protocols and patient caution resulted in lower volumes through the GP sort of space. So during this highly disruptive phase of the pandemic, which ran from March 2020 to officially September 22, there were some clear industry winners, and these included the pathology service provider, who were beneficiaries of higher margin COVID testing revenue that was funded by government. Some of the respiratory device manufacturers like Fisher & Paykel Healthcare, which experienced elevated ventilator demand from hospitals, as they themselves said, 10 years of sales in two for the industry. That's hard to cycle. And then thirdly, the fertility service providers, who were largely uninterrupted as an essential service. There were some clear net industry losers during this peak COVID period. Medical centres and radiology, obviously, GP shortages, but also patient caution and deferral of consultations during that phase, seeing GPs and specialists. Hospitals were severely impacted. As I mentioned, the nationalisation of bed capacity. We also saw elevated surgery cancellations, severe staffing shortages and workplace fatigue amongst nurses and doctors, and elevated absenteeism and sick leave. In the plasma industry was not immune either. We saw underutilisation of their collection centre network, largely due to safety and distancing protocols within the centres. Donor fees escalated, and that impacted collection costs. And ultimately, plasma supply was highly disrupted. In calendar year 2020, global plasma collections fell 20%. So as we now know and appreciate, this was an extraordinarily difficult and stressful period for healthcare operators and their staff to navigate, whether they were net winners or losers during this period. As we come out of COVID, the Australian government declared the emergency response finished in September 22 and removed all restrictions. Since that time, most healthcare subsectors have experienced some sort of steady quarter-on-quarter improvement in their underlying activity. However, some operators are still yet to return to a normal pre-COVID operating rhythm. Just as we witnessed during the peak COVID phase, there's been net winners and losers in that post-COVID environment. Some of the winners, plasma fractionation, companies like CSL, which saw a very strong rebound in raw plasma collections. Their CSL alone, their collections were up 31% in the 23 financial year. We're starting to see declining donor fees starting to normalise, still at heightened levels, but also improved asset utilisation of both their collection centre networks and their fractionation capacity that makes the end product. Respiratory device manufacturers like ResMed have benefited from a backlog in sleep lab testing to assess sleep apnea patients. We've also seen strong growth in home sleep testing in the US particularly, which is expanding the sleep apnea patient funnel. We've seen normalisation of the component supply chains and lower freight costs, which impacted them. In the radiology and diagnostic imaging sector, we've seen improved Medicare indexation, quite encouraging. A strong volume recovery where they're achieving above long-term average growth rates, and an ongoing positive mix shift to higher margin modalities like CT, MRI and PET scans. On the other side of the ledger, there's been net losers in the post-COVID environment as well. Medical centres are still seeing sluggish recovery in face-to-face GP consultations, partly a function of the telehealth option, but equally Medicare indexation in that space has run well below cost inflation, and that's led to rising out-of-pocket costs for patients. Pathology providers saw a rapid unwind of that COVID testing revenue pool. They've also seen a sluggish recovery in GP referrals that moves down the chain. And sadly, this sector has had no Medicare indexation for 24 years, which is extraordinary. In the hospital space, we've seen a slower recovery in certain specialist services like mental health and rehab, ongoing nursing shortages and elevated wage inflation in that space as well, which is pressuring margins. And again, government tariffs and private health insurance indexation outcomes that are running below cost and wage inflation. A tough period. So apart from COVID impacts, we've also witnessed some elevated share price volatility in certain core healthcare companies in the last 6 months or so. Some of this volatility relates to what we would classify as a company own goal. For example, Healius. Healius's operational and share price performance has been very disappointing following the COVID peak. We believe the board and management effectively wasted its revenue and earnings windfall from COVID testing by overpaying for the Agilex acquisition, and rather than deploying that surplus capital to accelerate their pathology transformation program, rather than deploying that capital into that program, including consolidation of their national lab network. This poor strategy decision culminated in a dilutive equity raising in November 23, an earnings downgrade, and ultimately board and executive upheaval. Ramsay Health Care continues to face some short-term challenges despite a steady recovery in surgical activity in most regions. Near term, however, the biggest operational challenge they face is achieving a better government tariff outcome for its Santé portfolio in France. The 2024-25 French government tariff for the private hospital sector fell well short of industry expectations, barely positive. And this is even more so relative to the public hospital tariff outcome, which was above 4%. And this is despite elevated cost and wage inflation that's been experienced across the entire industry. The private hospital sector in France continues to push for an uplift to this tariff, and Santé Management is leading those industry negotiations as a market leader. This latest French tariff outcome remains a short-term drag on the pace of recovery in Santé and group earnings for Ramsay. The Ramsay board is actively considering all options for the Santé portfolio. However, it is also mindful of maximising value for its shareholders. Near term, a sale of the French assets, we believe, would be highly unlikely without better outcomes on the tariff. Arguably, Ramsay was the most severely affected ASX-listed healthcare company during peak COVID. However, its Australian and UK operations are exhibiting more encouraging signs of a recovery towards pre-COVID activity. And this provides a pathway, hopefully, to margin restoration. More particularly, a full recovery in their operating theatre activity should underpin that margin improvement. Two major international healthcare companies, CSL and ResMed, have experienced recent price volatility, which has been more sentiment-driven and largely associated with the potential impacts of GLP-1 drug developments on their operations. Over a period of September to December, we undertook some really intensive research on CSL and ResMed during that period of negative sentiment, and believe the equity market response at the time was a significant overreaction to likely outcomes. Nevertheless, that volatility gave Argo the opportunity to establish a new holding in ResMed, and we also added to our holding in CSL. We've monitored ResMed's progress over many, many years. However, its premium valuation has typically been a sticking point, and that recent share price weakness associated with GLP-1 euphoria provided what we believe is a once-in-a-decade buying opportunity. Over the next 2 to 3 years, ResMed should also benefit from some serious operating constraints that are imposed on its key competitor, Philips Respironics, and this follows a major mask product recall. Philips Respironics is now also subject to an extremely onerous consent decree imposed by the US regulator, the FDA, and that consent decree will preclude Philips Respironics from taking on any new sleep apnea patients in the US market until the FDA determines otherwise. So it's a great opportunity for ResMed to build share. For CSL, the operational recovery now underway in its core plasma operations will be the engine room of group earnings growth over the next 5 years. The bearing division contributes about 70% of CSL group earnings and is expected to grow in the mid-teens over this period. Plasma volume demand continues to grow at 7 to 8% per annum and revenue growth of 9 to 10%. The bearing business will also benefit from a meaningful margin recovery back to pre-COVID levels over the next 3 to 5 years, driven by improved utilisation of its existing collection centres, effectively sweating the assets, lower donor fees, which is already happening, a transition to a higher-yielding plasma collection platform called RECA, and significantly lower group capex, down around 30% from last year for the next 3 years, and that follows 3 to 4 years of heavy investment in plasma fractionation capacity and other growth projects. CSL's flu vaccine business, which is about 17% of group earnings, continues to benefit from an ongoing mix shift from egg-based vaccines to cell-based vaccine manufacture. And this is a higher priced, higher yielding product with no immediate cell-based competition. ResMed and CSL are high quality companies with strong market positions in the US and rest of the world. Both of them have a strong growth pathway with significant opportunities in underpenetrated and undiagnosed markets in which they operate. For ResMed, that's the sleep apnea market, or OSA. For CSL, it's plasma, flu vaccines, chronic kidney disease, and anemia markets. Lastly, we thought we should take this opportunity to mention an interesting radiopharmaceutical company that Argo added to its portfolio in October 21. Clarity Pharmaceuticals is run by a highly talented board and executive management team with a track record of success in the targeted radiopharmaceutical space. It is a very innovative company deploying copper-based radioisotopes for diagnostic and therapeutic application in prostate cancer and other pan-cancers. Clarity's copper-based chemistry platform is highly differentiated from nuclear-based radioisotopes currently deployed in the space. And since IPO, the company has consistently met or exceeded its key milestones as it continues to progress its clinical trial pipeline towards commercialisation. More recently, the company reported some exceptional clinical outcomes for a cohort of prostate cancer patients following a single dose of its targeted copper-67 therapeutic drug. Some of these patients had previously failed up to 6 lines of cancer therapy, yet they reported extreme reductions in PSA, some to an undetectable level, following imaging just 6 months after the copper-67 therapy. In recent months, the radiopharmaceutical sector has seen a series of large M&A transactions announced as some of the pharmaceutical gorillas in the space seek to position themselves to participate in future growth in the radiopharmaceutical space. This hunt for companies with intellectual property, coupled with impressive therapeutic pipelines, has been a driver of some of this M&A activity. Yet a lot of those targets are far less advanced in their clinical trials than Clarity is today, and arguably with unproven product. Clarity has little, if any, competition in the copper-based radiopharmaceutical diagnostic and therapeutic space, and following recent share price performance, the board opportunistically raised some additional capital, and it remains well capitalised to progress its expanding clinical pipeline towards commercialisation, with initial product expected to be launched in the US in early 26. Due to the lengthy staging of clinical trial programs, as I mentioned before, Argo rarely invests in this sector. However, given the unique intellectual property and platform features that we saw in Clarity, we felt this justified a small initial investment at IPO. Since then, we prudently built that holding during a period of severe price volatility, which impacted the entire biotech space during 2022. And that volatility was despite Clarity consistently hitting or exceeding its milestones. We note that a significant number of new institutions, about 19 in total, participated in their recent capital raising at $2.55. Given the company's recent exceptional clinical trial outcomes, we would not be surprised to see strategic interest in Clarity grow over time. So in summary, with a return to a more normal operating environment, we're confident that the healthcare sector can deliver operating performance and shareholder returns consistent with the many years that we saw prior to the pandemic. And with that, I'll pass back to Jason.
It's a busy space. So I guess looking ahead, and I touched on this at the beginning, and the US economy and stock markets dominate globally. So literally, the US sneezes and the world catches a cold. And so there's two events in the US that I think markets are really hanging on. The next move in US interest rates, it's probably one of the most anticipated events for global investors. And each data point is closely scrutinised, every comment from every member of the Fed. And I think Powell speaks again tomorrow or tonight. And it's a big deal. So what this chart actually is showing is the predicted number of rate cuts in the US for calendar year 24. So back at the start of the year, I guess January, the market was expecting 6 or 7 rate cuts, which probably supported some of the share market rally. As it is now, we're back to under 2. And this volatility, I guess, is what has made, markets challenging. So, we've got 2 rate cuts in. It was 6, but is it going up or down? So it's hard to call. I mean, the prospect of a US recession, which I guess was the risk for last year, that's very, very unlikely. And, we're moving into, I guess, a US election cycle, which will be, fairly stimulatory for the economy. So 2024 is a large number of global elections. I think I read somewhere that there was over 3.5 billion people to the polls this year. And so we've still got, clearly the US, but UK, India, Mexico, South Africa, and another number of other countries. I mean, the US election clearly is the big one, and it'll be one of the most watched and probably polarising events to take place this year. An incumbent president returning, probably not a lot of change. Maybe there's some things at the margin, but a change of president could drive, substantial changes in trade policy, foreign policy, regulation, tax policy. The election's 6 months away, and that's still some time. But at least according to the bookies, it's pretty much a line ball. I guess if Trump stays out of jail. And look, it'll be fascinating to ask Tyler. His views. He lives in New York. He's probably surrounded by this. I guess his views on the election, but I guess maybe the impacts on the economy and particularly infrastructure, depending on who gets in. The US economy remains strong, largely driven by these 7 magnificent stocks, so they're called the Magnificent 7. It includes Apple, Microsoft, and Nvidia now, and they continue to drive the earnings really of the market. These 7 stocks are now half of the NASDAQ. Now, the NASDAQ's got 3,600 and something stocks. So those 7 are more than half of it, and they now make up a third of the S&P 500. So the earnings growth in those stocks is really driving this. So these is the I guess, expected earnings from the market overall in the forward-looking years. So they're relatively solid. From the perspective of the Australian market, it's probably less compelling. Earnings prospects are much more subdued, and I guess have been downgraded somewhat in recent time. Some of this is the mix of the market. We talked about the banks and their earnings are going backwards. Well, that's 25% of the market. The other big part of the market here is resources. Materials about 25% as well. So that's 50% of the market that I guess currently don't have much earnings growth. But having said that, commodity prices are very strong at the moment across the board, the base metals, gold, iron ore. So if there's upgrades to the materials companies, and they can be material, those numbers will tick back up. But as it stands, I guess consensus is looking for 5 to 6% for FY25. Seems reasonable, but it will depend, I guess, largely on resources. Domestic inflation is now mainly in the services side of the economy, so insurance, education, healthcare. Increasing rents is a large problem in an undersupplied housing market, and that's been aggravated by strong immigration. So the cost of living has been a major issue for community, and that's flowed through. It's now a major issue for government. And we can see this in this weak consumer confidence. So the dark blue line down the bottom is the Australian consumer confidence number. which has fallen back and really not got off the canvas since the COVID pandemic levels, which is quite surprising considering markets are at record highs, housing prices haven't really been impacted by the interest rates. But the federal budget, the government have noticed this, they've seen this, and I think they've wanted to make a point on these issues. So the budget last week was fairly stimulatory to support consumers in the near term. We don't think it makes a big difference, I guess, to corporate earnings. However, the commitment to support the more vulnerable parts of the economy, it should help market sentiment and support earnings confidence. So despite, I guess, the weak consumer confidence, we think Australia is faring relatively well. Corporate Australia is in good health. The balance sheets of companies are strong. Unemployment is low, and the government is supportive. So despite markets hitting all-time highs, and I said we've been a little conservative probably, easy in hindsight, but we continue to take a conservative approach to managing the portfolio. We have no debt, we have cash available, and we believe we're well positioned to navigate any changes that come up in the current environment. So that's, I guess, the end of the presentation for Argo, and now we'll quickly do a presentation on ALI. There'll be plenty of time for Q&A following that on both companies or anything to do with the market. So Argo Infrastructure is coming up to its 9th anniversary in July. And look, we're generally pleased with how it's performed and grown. The asset value's increased. There's a consistent fully franked dividend coming to shareholders. And so, we're pleased with that outcome. The asset class itself, listed infrastructure, has performed largely as we hoped. It's got a low correlation to Australian equities, and general equities are probably broader than that. So we do think it provides and continues to provide great diversification as part of a person's portfolio. Look, listed infrastructure has had some challenges in a rapidly increasing interest rate environment, and we've seen that. I mean, great examples here are two of Australia's biggest or last standing, I guess, but Transurban and APA. Those share prices have been very weak, and some of that is a result of the yields don't look as attractive versus, I guess, cash, but also these businesses carry a lot of debt. The cost of capital, when you run them through, I guess, your model of how you value these businesses, it lowers the valuation. So, the asset class has had, some headwinds. We do think they will turn to tailwinds as the interest rate cycle progresses and we do move to rate cuts. ALI, of course, as I mentioned with Argo, the LIC sector has come under some pressure for a number of reasons. And so there's also the compound of some of the discounts in the LIC sector. But we do believe the asset class is coming into some tailwinds from the rate cutting cycle. And when it does begin, it should bring some investor interest back to the space. Argo's relationship with Cohen & Steers remains excellent. They've been a great partner through this. And Tyler coming out to do the roadshow for the week is testament to that, plus anything else we need from an information perspective, presentations. And we genuinely believe that we look forward to running and growing ALI for shareholders for many years to come. But in the interest of time, and I think to get the benefit out of Tyler talking about what he knows best, I'm going to pass to Tyler. So thank you.
Great. Thanks, everybody, for your time this morning. So I'm going to briefly go through sort of the case for global infrastructure. What is this asset class? What is it when you invest in the fund? Why now? As Jason alluded to, we think performance has been strong, but we do think that the makings of a really good market for infrastructure assets are coming together. And then we'll talk a little bit about sort of why Cohen & Steers and some opportunities that we're really excited about. So some key characteristics of infrastructure as an asset class you can see here. I mean, broadly speaking, these are the large assets that help the global economy run. It's the assets that move people, airports and so forth, that move goods, that move energy, that make sure everything that we expect in terms of our day-to-day lives can operate. Really good businesses because of a few sort of unique characteristics. Very high barriers to entry. It's really tough to build things like airports and toll roads. So once you own the assets and you have them in service, that gives you a really good advantage to grow your business at fairly attractive returns. Very predictable and oftentimes inflation-linked cash flows. We'll talk about why that's valuable in the market that we see coming up. long-lived assets, so things that you can expect to provide cash flow for many years and decades in the future, and then a very stable asset class. We think infrastructure is important because it is not super correlated to equity markets and credit markets. Attractive downside protection, lower volatility. When equities are down, infrastructure tends to be down a lot less. Again, when inflation's high, infrastructure tends to do very well. And some major sort of mega trends that we think will continue will bolster sort of opportunities across infrastructure. We'll talk about a few of these in more detail, but things like the aging infrastructure in the developed world. I mean, in New York, we had 3 of the worst airports globally, although they've refurbished them recently. But the need to build better infrastructure in the developed world, the need to build new infrastructure in the developing world, handling global population growth, handling urbanization, handling a lot of the technological advancements that we're seeing. And we'll talk a little bit about AI and how that's even seeping into infrastructure as an asset class. So finally, what is it? What do you get when you invest in an infrastructure fund? Again, it can mean a lot of different things, but we sort of define the world as 4 key subsectors. An acronym that I use, although it's not in this order, it's the CUTE subsectors. So communications, this is saying things like cell towers, satellites, and data centers. Utilities all the way on the right. So electric, gas, water utilities, and then clearly renewables are a big part of what we're seeing in terms of growth for the utility space. Transportation, so toll roads, marine ports, railways, and airports. And then lastly, the midstream segment of the energy value chain. So we don't invest in producers of commodities, but we do invest in those companies that transport the commodities from where it's produced to where it's consumed. So why infrastructure now? Markets are at all-time highs. Infrastructure's done okay, but we feel very good about sort of where we stand going forward based on a couple sort of key macro trends and some more sort of micro opportunities that we see. Differentiated performance profile, and we'll talk a little bit about some of the valuation opportunities of infrastructure versus equities. So this next slide, you might have to take out binoculars to look at it because there's lots of small words and lots of different charts. So I'm going to try to explain it as best I can fairly quickly. So what does it show? Well, first is there's 2 worlds that we can be living in. One world would be interest rates are rising, and then one world would be interest rates are declining. So the top half of the page is what happens when interest rates are rising. The bottom half of the slide is what happens when interest rates are falling. And then we kind of say, hey, there's 2 things that matter for market expectations. Obviously, there's a million things that matter, but the 2 core things would be, what's happening with global growth? Are things getting better or worse? And then what's happening with global inflation? Is inflation surprising higher or is inflation surprising lower? What I would note is in 2023, we were in a very unique period where growth was actually very strong, a lot stronger than people expected, and inflation actually came down. It didn't decline and go negative, but it came off very high year-over-year levels to much lower year-over-year levels. We actually think that the inflation side was cyclical and inflation will reaccelerate higher. And we do worry that global growth has sort of run its course. Global growth will still be okay, but it's definitely going to, we think, start to do a little bit worse than expectations. So we think we're transitioning from that second column on the left to the column 1 to the right of it, which is a world where inflation is higher and growth is lower. And in that world, what I would say is infrastructure does really well relative to equities, irrespective of what's going on with interest rates. Now, why would that be? What are the characteristics of infrastructure as an asset class? I would say, hey, these businesses will do well in inflationary periods. What I'd say is, if you're worried about inflation, you want to invest in businesses that have 4 key characteristics. The first would be a business that has pricing power. Hey, costs are going up. Can they raise their cost to their own customers to deal with that? So you want pricing power. You want high margins. If you generate very high margins, so your revenue is 100 and your costs are 30, high inflation doesn't impact you as much. You want to have mostly fixed costs. So you don't want to have to pay people more every year, but are you just dealing with the fixed cost of a network, for instance? And then you want long-term fixed rate debt. By definition, infrastructure has those things. These are assets you need to run. They often have inflation protection by contract or by regulation. Really good pricing power. Tough to build, but once you build them, very high margins. Many businesses run at 70% margins. So for every $100 of revenue, your costs are only 30. A lot of it is fixed costs, not variable costs. It's not very labor intensive, so you can contend with rising wages way better than other equities. And one of the nice things about infrastructure companies is they really did a good job terming out their debt. What that means is they don't have a lot of debt maturities in the next few years, and they've taken advantage of the low interest rate world that we've been in. So again, our macro view would be, hey, things were surprisingly good. Let's maybe get a little bit worried that they're going to surprise worse. And infrastructure, we think, will play out really well in that sort of environment. Uniquely, what I would say is if you agreed with that outlook, you'd probably say, yeah, but infrastructure is probably really expensive because people want this protection and they want this sort of downside protection. And the reality is that's not the case. So the chart on the left shows historical cash flow multiples of infrastructure and broad equities. So cash flow multiple is how many years of next year's cash flow will you pay to own the business? Right now, infrastructure trades at about an 11 times multiple. So if the business generates $10 of cash flow, you're willing to pay $110 for it. That's down quite a bit from what its multiples were a few years ago. And it's down because cash flows have grown, not because the stocks are down, but they've actually seen really good cash flow growth. That is very different than what you see in broad equities. Equities today are about a 12.5 times multiple. So that same $10 of cash flow, you have to pay $125 for. And that's up a lot in the last 18 months from where it was in sort of 2022. So multiples have gone up a lot in broad equities. What does that lead? It leads to the chart on the right, which is the valuation of infrastructure relative to equities. You've historically seen people reward infrastructure businesses with higher multiples. So we've historically traded at a 10% premium. That makes sense to us because these are stable, predictable businesses. So you're willing to pay a little bit more. They're trading at an 11% discount. I would make the argument that we should trade at a higher than historical average premium, but I'm not going to bother doing that because if we just get back to a 10% premium, that's a 21% gap. So you have this asset class that's well positioned for the macro environment we're in, and you're really not paying all that much for it, especially when you compare it to equities. And we think that's very unique. One of the reasons that we also are excited about infrastructure is, you here in Australia have seen a lot of infrastructure owned in private markets. That's a trend that's accelerated globally in the last decade or so. There's a lot of private equity money out there looking for these businesses. Again, predictable, good cash flow businesses. The chart on the top is what we call dry powder. How much cash is sitting sort of in the banks for all these private equity funds to spend? It's ballooned. And these funds have started to invest in listed companies, taking them private to spend their money. And so if you're investing in listed infrastructure companies like we do, that's really good support. I mean, again, here in Australia, Sydney Airport was taken private, I think about 18 months ago at a very, very high valuation relative to what the listed markets rewarded. So again, when you're invested in infrastructure, we think listed is a really good way to get exposure to the asset class. And listen, if private equity wants to come and pay a 50% premium for our business, we'll let them do that all day. A couple key themes in infrastructure today that I want to spend a little bit more time on are sort of three. One is an evolving global supply chain. We do believe deglobalization is happening, and it's going to be a massive retooling of global supply chains to deal with geopolitical stress and sort of the lack of reliance you want to have on single trade partners post-COVID. Digital transformation. We've been excited about the need for data consumption and so forth for a long time. AI is really making that even a bigger deal. I will say it's impossible to predict the future, but the one thing I am absolutely certain of, and if I come back a few years from now, you can hold me to it, we will all consume more data 5 years from now and 10 years from now and 20 years from now than we are today. And infrastructure businesses are those that sort of build the infrastructure required to make sure that the networks can satisfy this demand growth. Lastly, is the energy addition. You might say, hey, that's the wrong word, right? We're in an energy transition. We actually don't think that's the case. We think the world's need for energy is rising very quickly. That means we need to invest a ton in renewables. And we're really excited about investments in alternatives, but we're also going to rely on traditional forms of energy for a really long time. So market share, we'll see a transition where the percentage of energy from alternatives is going to rise. But we do think the sort of backbone of natural gas and nuclear and some other things is going to be required for a really long time. A little bit more on sort of the first two, which is the supply chain and the digital transformation. This shows a history of power demand in the US and also a prediction of the future. So a couple things that I'd sort of note about these two charts. The first is the one on the top left. And I'd say if you look on the left side of it, it shows in blue what the history of electricity demand in the US has been. And it's kind of a shocking chart because what you'd note is it hasn't grown at all since 2000. For the last 20 years, the US has not seen any increase in electricity demand, which surprises even us when we look at the data. That's changing. The chart on the bottom left shows the projected data center power demand. And every week, seemingly, this number is being revised even higher because the power and data consumption needs for artificial intelligence are massive. So a lot of people are saying, hey, I want to get exposure to AI and I want to go and buy these great tech companies. And I'd say, that's great. But guess what? You're going to need a lot of investment in infrastructure to facilitate that growth. And it's going to come in things like power demand, build more transmission wires, build more gas-fired generation, build more renewables and so forth. US utilities, as an example, is a great way to participate in this huge secular theme. Similarly, I talked about our view on deglobalization supply chains. To put this very simply, we think for the last 35 years until COVID, the world was sort of turning into a just-in-time inventory world. So you kind of said, hey, I'm a car manufacturer. I want to source my good from the cheapest place that can provide it to me. I'm not going to worry about if they can actually get me that good. I'm going to just buy everything from China or single source from wherever I can get it as cheaply as possible. Then COVID happened and you say, that's a problem. I need a little bit more redundancy in my supply chain. And then you saw some major scary global geopolitical events where you say, hey, some trade partners I don't want to rely on anymore. We think that that's a major opportunity for things like global ports. And so to make up the numbers on this, I'd say, hey, in 2019, maybe you had 100 units of port demand and you allocated all of that to China. So, hey, I need to consume 100 units and I just want to get it from China because it's cheap. Well, today, maybe you say, hey, I only want to get 75 units from China because I'm a little bit worried. But I also want to get 20 units of port demand from Brazil and 20 units of port demand from the Philippines and 20 more units of port demand from Mexico. So now from a world where I was consuming 100 units of ports, maybe I'm consuming 125. And guess what? This is a real estate business. We're not building any new global ports. So demand for ports is rising. Supply of ports isn't really going up. If you own the global port system, that's a really, really good opportunity. So again, an example of another secular theme that we're really excited about. A couple of stocks in particular that are big holdings in the portfolio that we think can put a little bit more just sort of reality around what we're doing would be sort of these four here. So just to spend a couple minutes on each of them, the first would be PPL Corporation. So this is a $21 billion US market cap regulated utility. We think the average regulated utility in the US is actually not really well positioned, but the top third are in a really good spot. So if you're a utility that has a really good balance sheet, that can invest a lot in transmission and alternatives, you've got really good regulatory relationships, you can take advantage of things like Amazon wanting to build a data center in your territory. We think that you can see really, really strong growth in both earnings and dividends. So PPL Corp, 6 to 8% earnings growth, offering sort of a 3.5% or so dividend yield, should be able to grow their dividend at least at that level. And we think there's an opportunity for even better growth over time, given AI and the ability to sort of transition away from coal and sort of do some other things within their service territories. The second one that I would talk about is Norfolk Southern, which is one of the sort of 6 publicly traded class 1 rails in the US or in North America. We think the freight rail business is one of the best businesses in the world. You will never be able to rebuild the US, North America's freight rail network again. We talked yesterday about an acronym that I like to use. We've transitioned away from a NIMBY world, not in my backyard, to a bananas world, which is build absolutely nothing anywhere near anything. You will never be able to rebuild the US's freight rail network. And so if you own the rail network, you're in a really good spot. One of the really interesting things about the US class 1 rails is they used to have a really crazy business model relative to their opportunity set. So until about 2005, the freight rails were run for their customers. What does that mean? What the average freight rail management team said was, hey, we want to make sure our customers are really happy. So the business model basically worked like this. Use a plane analogy. We've got a plane. We need to take off to go from here to Sydney. Let's have the plane take off after all the customers get here. That's pretty crazy, right? What if some customers are late? Suddenly your network becomes very, very inefficient. But that's actually how the US freight rails worked until about 2005. Then we came up with this really, really amazing sounding acronym, PSR. PSR means Precision Scheduled Railroading. That sounds like a really, really unique and differentiated business model. Guess what it is? It's just, hey, we're going to have a time where the train runs just like the plane takes off. If you're not there on time, sorry, you're on the next one. That's been a massive change in terms of the profitability of Class 1 freight rails in North America. Though we're sort of in the middle innings, or again, I use the baseball analogy, I guess we're in the third quarter of the football game. We think there's still a lot of opportunity for these businesses to continue to improve their margins. The last two that I'll mention briefly, ICT, International Container Terminal, is actually a Philippines-based largest port operator globally with assets across 6 continents. What's unique about them is they focus on something called origin and destination ports. So if you were to just simplify global ports, there's sort of 2 things that ports can do. One would be transshipment, and one would be origin and destination. So transshipment would be the good is built somewhere, it's put in a container, it comes to the port, and then you sort of move it and you put it on a different ship and you put it somewhere else. So again, transshipment would just mean, hey, we're going to get it all here and then we're going to break it up and put it somewhere else. Can be a good business, but obviously lower barrier to entry and sort of the boats could stop coming to you. Origin and destination is different. They focus on ports where the goods originate or they're consumed. Way better, we think. Suddenly the manufacturing base is there. They need to ship it out. You own the port where it originates. You can charge more for your services, a lot higher barrier to entry business. Similarly, if you own where it's destined to go, you oftentimes have a lot better business model. And we think that's a business model that's really well positioned going forward. And then lastly would be TC Energy, which is a large cap North American midstream energy business. We actually think natural gas is a really big part of the energy future. They have one of the best natural gas pipeline footprints across North America, really good management team. They also own some oil pipelines, which they are spinning out. And we think that's going to create a really good opportunity to unlock value, as those oil pipelines have caused certain investors to not be willing to own TC Energy. But you sort of move that off of the balance sheet. Those that want exposure to oil pipelines can now own that security. But then this sort of transition-focused natural gas business is really well positioned. So briefly on sort of the Cohen & Steers competitive advantages, we've been doing this for a really long time. We've been managing infrastructure portfolios since 2004. We have a global investment team with folks in New York, in London, and Hong Kong. Large market position. We manage to do the exchange rate, I think about 10 billion Aussie dollars in infrastructure securities. Manage about $120 billion in real assets securities more broadly, with a very sort of, we think, unique and rigorous investment process that's been time tested and generated good performance and alpha for our investors over time. I will skip the top 10 holdings, but all this is fair game in Q&A if you want to ask about any question, or if you have any questions on the companies that we own. And then I'll sort of leave here our investment team. Again, we're global in nature. We think that we're sort of best in class, large scale asset manager with sort of a boutique feel still. It's 4 portfolio managers with a long-term track record of managing these portfolios, assisted by a dedicated analyst team, again, spread around the world with best-in-class team resources across economic research and risk management and quant research. So to summarize, again, we covered most of these points already, but massive infrastructure investments are needed globally. We think it's compelling risk-adjusted returns in the asset class with low long-term correlations. We think listed is a really good way to get exposure. And again, this is a universe that, though there used to be a lot of Australian infrastructure companies, now there are a lot fewer, and now you can get exposure to sort of the global infrastructure index. I will not go through my background here, but you can see a little bit about my history, and I will give the floor back to Jason.